Okay, good morning, everyone. Thank you, Kavya. Many years ago, there was a book called Breakout Nation by Ruchir Sharma. He was then the head of the emerging markets team at Morgan Stanley. And in his book, he had talked about different emerging markets. Of course, India was one of them. And the title of the India chapter was The Great Indian Hope Trick. Right, we're always hopeful. So just I would like to start with a little excerpt from that book. So foreign analysts vie to predict how fast India will rise as an economic power and how soon it will regain the might it wielded 3 centuries ago when it accounted for merely 1/4 of world economic output. Every society is complex, but one as big and sprawling as India defies straight line, long-term forecasting more than most, right? So India is a complicated market, and thankfully we have a great panel here today who has been, observing and part of the Indian economy for a long period. So let's start the discussions. The first question that I have is, 2024 is the year of the elections. Not just India, but US, EU, and 64 other countries are having elections this year. So how do you think these elections and policy changes at a global scale will impact India and India's economy? Everyone?
Ladies first. Thank you, SIMSREE and young friends and my dear friends on the panel. We all know each other for many, many, many years, so it's great to be amongst friends here. Thanks, Sakshi, for that question, which is right on our minds for everyone. Yes, 2024 is the year where one more element of volatility gets added, in addition to what we have come out of in terms of COVID, in terms of ongoing wars, climate impact, and then you have 2024 with countries, about 60 odd countries, major economies, getting into election mode, choosing their new leaders or existing ones getting re-elected, constituting almost 40% of the world GDP. So there's bound to be an additional element of excitement as to if there is a continuity, obviously more predictable kind of a path towards growth, strategies, reforms, etc. would be underway. But for some reason, if major economies where elections are underway in 2024, if they throw surprises, then we definitely need to look out for either shocks of pleasant kind or unpleasant kind. And a particular biggest democracy in the West comes to your mind, where you choose between a democratic leader or a Republican leader. It's a scary thought at this point in time. Why do I say scary? Because more liberals would be in a realm of lack of young dynamic leadership there. And the other side would have some kind of induced volatility through very dramatic steps being taken to either disintegrate with the global economy or integrate with the global economy. And I can definitely say that without any embarrassment, that if Trump comes to power, then there is going to be even more degree of unpredictability in store for not just the US, but for the rest of the globe. China, India, all major emerging economies included. So while there is a growth slowdown thanks to all the events that I just mentioned, but in the recent quarters, I could say that there is a certain sense of comfort that somewhere the global economy has been able to bring inflation much lower. Of course, it's still higher than the mandated 2%, but the fact is from 7 to 8% plus inflation, these developed economies are now, cruising below and getting towards, gliding towards, below 4% inflation. Having said so, growth is going to be a challenge to get back to 4.5%, 5%. But recently, if you look at the JAN-VO World Economic Outlook by IMF, they actually raised the growth forecast by 20 basis points. It was essentially because there was a perception of hard landing by US, which never is on the horizon, in my opinion. Perhaps it could be no landing because the recent numbers on labor markets, on high frequency economic indicators seem to suggest that economy in the US is looking still very resilient, and therefore the rate cut anticipation by the markets to spur growth seem to be getting pushed, and perhaps this is the first time that you're seeing markets actually now trying to toe the line of the Fed's peak. Fed is trying to push the expectation of rate cuts, both in terms of magnitude and timing. But in the recent times you've seen, and when I say recent times, maybe just a month. Nowadays the time horizons have changed. Long term is 2 years nowadays. So the short point of the very long answer is that there is a lot of volatility, there is a lot of uncertainty. I think India has stood out because it focused on counter-cyclical steps, particularly on the FISC side, focused on macroeconomic stability, focusing on getting inflation lower, embedding reforms so that growth, when things begin to show some normalcy, starts to pick up, and that's what happened yesterday. I'm sure everyone in the market was shocked, but don't get carried away by 8.4. You know, it is a lot of numbers that you need to look more closely. But the fact is, we are coming close to sustaining 7% growth, which is a big deal. So I think in that kind of economic environment across the globe, that's why India has suddenly become the place to be in for every other economy.
Ajay, would you like to add?
I think Shubhada has really covered all aspects. So I don't have anything additional other than just this point that geopolitically the globe looks obviously a little uncertain. And Shubhada touched upon it. On the Middle East, we have stresses building, and Israel is just continuing to push and pummel, so to say, Hamas and the adjoining region. So I think there are those sort of global risks that we can't shove under the carpet at this moment of time. Of course, India, as Shubhada said, is in a pretty much Goldilocks stage, largely driven by the fact that we don't really depend on the globe for our growth. We are a very large sort of middle class market, and there is a huge amount of consumption and growth, whether it's automobiles or construction or housing or anything else across sectors. The growth is being fed by local factors and not by global factors, and I think that insulates India substantially from the rest of the globe. But if you look at the globe, I think there are massive uncertainties. There is a huge polarization between powers that be in the West versus Russia, versus China, versus, not versus, but Middle East. Again, there are loyalties different countries have to the West. And, there is, of course, people rule out a world war and all that, so I don't want to sound too negative about this. But the fact is that these pressures and polarizations will keep us a little bit on the tenterhooks with regard to any negative impulses that can come from the globe that could impact Indian sort of growth as well, and if not topple the apple cart, but definitely put pressures on the Indian economy. But let's stay positive, and even with these elections, I think whether it is, I agree with Shubhada that Trump will definitely add to volatility, but we have seen his previous 5 years. I mean, he will blow hot, blow cold on many issues, create a lot of noise, but at the end of the day, nothing much changes, honestly. So foreign policy towards India not likely to majorly change. And we being in India and looking at the outlook for India, I think overall we seem to be in a fairly good situation at this moment of time.
Thank you. Mangesh?
Yeah, so I mean, a lot of things have been said, and not much for me to add. But maybe when we look at geopolitics, it has been volatile for last few years, and there is some kind of deglobalization, or deglobalization is a bit stronger word, but let's say weakening of the globalization, and especially when we look at it from the manufacturing viewpoint. Services sector probably still don't feel that because of technology, and technology still spurs globalization when it comes to services. But for manufacturing sectors and commodities, there have been a lot of supply chain disruptions related to geopolitical events. There have been tariff escalations. And last time in the US, after the regime changed, so from President Trump to President Biden, still those tariff escalations didn't go away. Tariff escalations have stayed. So that speaks a lot about the way the world is changing, people's opinions are changing. So in the elections, I think a couple of things in addition to what has been said, we should look out for. One is, I think, what impact will have on the climate change. So climate change related, there is a lot of consensus today in the world that we should move to the transitioning, decarbonization. Whether that consensus suffers after the elections, if like Trump comes back, whether that consensus, it won't go away definitely. The force itself is very strong. But if it dilutes or weakens a little bit, I think that's one area to watch out for. Second area, I think, is about the tendencies towards, let's say, migration or free trade, which are actually changing in the US, in Europe. And if the elections that happen, they strengthen the voices of those who are against that integration, that's something which will, at the margin, it affects India or people from India who are, say, wanting to migrate and participate in the global growth story. So on margin there are negative factors, but like I think Ajay was also saying, India, our own story remains pretty strong and somewhat less dependent on what fluctuations are happening globally. So that's, I think, a positive sign.
Thank you. So lot of follow-up questions, but let's begin step by step. The first thing is, you rightly said, inflation is, we have been able to control it to some extent and also globally, but it has a cost, right? The rates have increased. The federal rate is 5.5 in India, we have the repo rate 6.5, and so ultimately the cost of capital is increasing. If I talk to, these are first year students, you've done NPV, I'm sure, calculations, and the discount rate is increasing. So how does it impact, right, the fact that interest rates are increasing, and what do you see the trajectory for, let's say, the next 1 year or 3 years? I was going to say 10 years, but then you said that's not long, that's utopian. So let's take the 1 and 3 year horizons. How do you think this interest rate trajectory would play out?
Let me get started. I'm sure I'll look to the comments from other panelists as well. My view on this is that I think there was a catch-up on inflation that didn't play out for a very, very long time. I remember the September 2001 attacks. I start there on the World Trade Center, unfortunately, which led to the US rates getting cut all the way to 1%. And from there till 2008, until the GFC, rates remained low. And after that, the central banks got another opportunity, particularly the Western Central Bank, US, got another opportunity to keep rates for far too long at the very low level, right? So they were near zero. We used to call it zero rates. I remind the audiences that until 3 years ago, the Swiss rates and many other countries had negative rates going all the way up to 50 years. So I remember one of the bond issuances of the Swiss National Bank, which for 50 years paid negative 3%, which means that if you put 100 Swiss francs to work in Switzerland 3 years ago, you would get back 97 Swiss francs after 50 years. And there was $15 trillion of bonds globally that were earning negative interest rates in G3, G7 countries. From that situation, we are at a stage where all yield curves, to the best of my knowledge, are upward sloping. Inflation pressures, of course, have caused central banks to become fairly wary. I think the reality is that the amount of money that has been pumped in over the years into propping up the economy and deal with these crises that happened 2001, 2008, and then continuously thereafter, more geopolitical uncertainty causing growth pressures in some economies. All of that has imparted a very, very strong push to inflation. I don't think inflation crashes down all the way to levels of 1% that we have seen in global markets for a very long time. I think we are in for a more stable inflation level across the world. Financial markets, people like me, people like the traders, the investors, they will constantly look at one vector or the other for finding the next opportunity in the marketplace. So a lot of us have now started to dream about interest rates in the US. I remember a report about 2 months ago, which UBS put out saying by the end of 2024, US LIBOR rates will go down to 2.5%. From levels of 5+, right? So they were talking of 2.5% cuts. I think at most we will see a 50 basis point cut by the Fed, 2 cuts, and after that the rest of the world will continuously and the Fed will watch before cutting further. I think the super inflationary forces created by huge money supply in the US, in the order of tens of trillions of dollars pumped over 2 decades, cannot be wished away by saying that we will have a slowdown of a very rapid kind. As Dr. Rao said, we are seeing plateauing at this moment of time. We'll probably see soft landing in the US. We will not see massive growth pressures at this moment of time. I can't see that. And I also see that India has moved from something like 5.3% 10-year yields 3 years ago to 7.1, 7.2 10-year yields. Repo rates have moved from something like 5.25 to 6.5. So there is a massive move in the repo rates in India. I think our country has been run in a fairly conservative manner. We have raised rapidly, and I think India has potential, to my mind, to probably drop rates by 75 basis points in a year's time from now. But I don't see anything more stark than that.
75. I'll hold you
50
to
to
that.
75, but I would err on the side of 75. Yeah.
Wow, the trading and economists' view are matching almost. That's a rare thing to happen. So, I mean, great what Ajay said is, concurred to completely. Just to add an economics spiel to it, when did the story begin is in the recent years was Fed insisting that inflation was transitory. And for long, the markets believed that inflation is not transitory, but Fed actually erred very badly in terms of calling it a transitory phenomenon. Soon enough, they realized that inflation was getting embedded. And once the COVID had started and the war soon after close to the heels, we saw inflation being led by, supply shocks. Which incidentally has then begun to ease if you look at major indices which measure the supply shocks kind of a metric. So that actually brought down the inflation from maybe 8 or 9% to about currently 3% over the last 12 to 18 months. But, there we have to make a distinction. It is for India, for an emerging economy like India, our threshold band of 2 to 6%, a tolerance band has always been at a higher end. From that 6%, our inflation hadn't deviated significantly largely. We went to 8%, close to 7.75, 8%, but the 6 to 8% was relatively just about a 200 basis point deviation, whereas for US, it was 600 basis point deviation. So it also matters in terms of perception of inflation. So US had to struggle a lot, and therefore the interest rates went to record levels, the Fed rate went to record levels. Since then, as Ajay rightly put it out, that because the balance sheets have expanded so dramatically, it's going to be a tough call for the Fed and the Treasury to bring it down in a very smooth, undisruptive manner. That's going to be a bit of a challenge, where an economy is starved for funding, for growth. Aspiration is obviously for US to get back to 3, 4, 5% growth. That's not going to happen in a hurry because, as Ajay mentioned, Fed rate at best our view is, I mean, you look at the market implied rate. They started maybe 3 months ago, the expectation from the market was close to 100 to 150 basis point of rate cut by Fed. That actually has come off, as I saw it yesterday, market implied rate has come off to 80 basis points, and the timing of rate cut, which was being expected first in January, then in March, has now got pushed to June. And the reason being that inflation is still at a higher level. For US, 2 to 3%, that 100 basis point is also a big deal. So it's going to take a while for US to come back to 2% inflation. Until such time, Fed will give it a shot to push back very dramatic expectations from the market. Coming to India, I think we may wish away the influence of Fed, but the fact is that most of the central banks across emerging markets in particular will toe or time their interest rates once Fed begins to pivot. It's not likely to we are not likely to see a scenario where RBI will preempt a rate cut before Fed does. So if Fed is actually cutting rates sometime starting June, we could safely expect RBI, and our call is that RBI would effect rate cutting pivot to start from either August, or our actual base case scenario is October, because that time India remains vulnerable to food shocks in terms of domestic inflation trajectory. Monsoon season would have gotten over. RBI will have a fair sense in terms of the agriculture output and so on. We know by yesterday's GDP that agriculture in fiscal 24 has been very weak, just at about, for the full year, at less than 1%. It's about more than a decade low. So food shocks will have to be taken on board. So even for RBI, the rate cutting cycle and the magnitude of rate cuts is not going to be beyond 75 basis points. And that's where I said our views match. So between October and March, we see RBI actually going in for a shallow rate cut cycle, max 75, but our own assessment is 50 to 75 basis points. So are we going to see, the era of, 2004 to 6, that kind of a time, before the GFC, where we had rates supporting growth? Perhaps the world has gone past that situation. Expansion of balance sheets has happened across the DMs. It's going to take a while. And for India, it's more of the domestic drivers of imbalances, which is going to drive the inflation and therefore the interest rate story. So entirely concur with Ajay that we are unlikely to see the crashing of interest rate kind of a scenario at all. I wouldn't even say anytime soon, but I'd kind of rule it out at least over the next few years, because we have far too many uncertainties to deal with. We've not even completely encapsulated and measured the impact of climate change on both growth and inflation. And of course, if the flare-up in Mideast gets more broader, that adds further to the vulnerabilities for energy-dependent economies. Europe, for that matter, looks very vulnerable today in terms of its growth, in terms of its inflation, because for Europe, Red Sea matters. And look at the logistic and insurance costs therein. Look at the energy costs. Once again, they're going to get into some energy cost issues. So basically, it's so much fraught with new elements of uncertainty and volatility that it's not going to be a normal, back to normal kind of a scenario, at least in the foreseeable future.
So, both inflation and interest rates, I think the way to think about it is, if you are comparing it against what happened, say, after the Ukraine war, supply chain disruptions, then expect things to ease out. Inflation is easing and so will interest rates. But if you compare it against, let's say, what was considered a normal before pandemic, for a long time, there were expectations that inflation is kind of dying, very low, and therefore low interest rates, then definitely, interest rates in the medium term are going to stay higher than that. And I think 2-3 fundamental reasons. I'm talking little medium term because I think the other aspects were already covered. But from the medium term, as I was saying earlier, globalization coming down, so tariff escalations are there, supply chain disruptions happening more frequently, the climate events happening more frequently, so that creates more frequent supply shocks. Also, after the pandemic, the world has gotten used to higher fiscal deficits. There is a lot of tolerance about higher fiscal deficits now. I mean, US fiscal deficit at 6%. I remember if some years back they would have said, India at 6%, very high, bring it down. Today in US, no one, blinks an eyelid with a 6% kind of fiscal deficit. So a lot of tolerance for deficits. So all of these factors actually support keeping inflation a little higher than what it used to be historically, and therefore also the interest rates. So in case of India, I think some other factors like Shubhada mentioned about food prices, food shocks. That's a very important factor. I mean, sometimes these calls on inflation are a bit like that. Pre-cricket match commentary. I mean, people look at the pitch. They look at the past historical record of when the two sides have met, what happens. But what the commentators don't know is what mood Pollard is in today. So the food shocks in India are something like that. Suddenly something will erupt, and I mean, you would suddenly have some onions inflation, potatoes, and suddenly it can cause a shock. So that's always a risk when we are doing shorter term forecasting on inflation.
Just one point that I forgot to add was why inflation also may not come crashing down is after what has happened in China, you have a China +1 or basically a diversification of production. And these, when they are in transition, are always inflationary. For example, every country is now, as my colleague Vivek puts it, is in an arms race of chip manufacturing. Okay, now China has done it with scale. All other economies will take a while to reach a scale to have a benefit of lower cost of production. So till such transition happens, and as Mangesh was also earlier alluding to, was that there may not be deglobalization, but there is a certain element of protectionism, a small degree of protectionism, which is, feel proud about your own country and that I produce. So all these things may actually defy the Ricardian theory, that the whole thing of trade is, we are going to see a transition of these, everyone is now reverting to industrial policy. And that will have its costs in terms of keeping the inflation higher.
So, when the US sneezes, the world catches a cold, but also at the same time you have to worry about farmers. So it's a very wide range of factors that one has to consider. So coming a little back to India, right? So India, we have high bank liquidity deficit. In Jan, it was almost 3.34 trillion rupees. It was like we had tax payments and everything, and now it has shrunk to 1.4 lakh. But still, it is very high. So, do you think the market is resilient enough to handle these interbank liquidity shocks? Because that is something that affects on a day-to-day basis, right? More urgent basis.
You're talking about the systemic liquidity.
Yeah, interbank liquidity. Yes.
Yeah, so while this is more honestly up their sleeve on interbank liquidity, because I've been a little away from the markets, but I'll give you my 2 cents on this. I think the RBI this is my perception, I could be wrong, is very focused on making liquidity steps be in sync with their interest rate policy actions, right? Last couple of years, India has been raising rates to counter inflation. And as Shubhada said, the CPI had hit higher levels, and they have now, it's begun to moderate. We are now at 5.4 or something like that CPI, and I think next year we should moderate further down to 4.5%. So I think the liquidity actions have been to sterilize excess liquidity. I remember 2 years ago, I would read reports that there was as much as 7 trillion rupees of liquidity, surplus liquidity, that was going to RBI in reverse repos and so on and so forth.
But that was a different
That was
we had COVID and all that.
That was through COVID, right?
Yeah.
2 years ago.
Yes.
After that, it more stabilized around the 2 trillion mark, and then now they are wiping out liquidity. And I'm told that the liquidity in the system has improved in the last couple of weeks with government spending and moderation in
Year-end spending.
The government year-end spending and so on and so forth. So they did a VRR auctions of 83,000 crores is what I read recently. The point simply is that on the liquidity side, to expect RBI to actually inject liquidity at a time when interested action is the other way is going to be very hard. They want the liquidity. I remember about 10 years ago when I was more actively involved in banking, it used to be -1 to +1% of NDTL, which is what the liquidity management of RBI used to be broadly in. I think we will get back to that once moderation in interest rates is achieved in about 3 to 6 months' time. Till that time, the RBI is resolute that they do not want to give a counteractive impulse to the market on liquidity versus where they want interested action to be. I'll hand this off to my colleagues here. Yeah.
So for liquidity, of course, currently it is about, say, so we have different ways of measuring liquidity, systemic liquidity. One is actually the headline liquidity, what you see in the markets. The second element to this liquidity is the government's cash balances with RBI. Basically, it is what the government has garnered in terms of tax collections or whatever, and it's parked with RBI until a point where it sees the need to spend. Okay, so we define liquidity in our own terms as core liquidity, which is basically your headline liquidity plus the cash balances of the government with the RBI, which is actually the liquidity available, but it is at the moment segmented into RBI account. Okay, now that currently stands, say, about 2.1 trillion in the system, which is about how much would it be? About 2% of NDTL. We expect by end March, it will come down from 2.1 to 1.6 trillion, which is once again 1.5 or thereabouts of NDTL. Now, in this, we have to be very careful in frictional factors adding to liquidity drying up, or whether drying up or adding. So, tax collections, for instance, now mid of the month, you will see advanced tax outflows. By 15th or 16th of March, you will see a huge drain of liquidity out of the, from banks, then it will go to the government, right? So that will cause a drying up of liquidity. At that time, maybe the RBI would actually pump in money through VRRR, okay? But at that point, if the government decides in last 20 days to start spending, because 31st March they have deadlines to spend, there would be huge inflow of liquidity in maybe the last week. That time, maybe RBI would time it by tools of VRR instead of any other. Are we looking at, so frictional factors of adding or subtracting of liquidity from the system will be dealt with by RBI through VRR or VRRR, whatever the appropriate situation. In terms of structural, I don't think RBI, as Ajay absolutely hit the nail on the head, is you have to be in sync with what your stance is of monetary policy. And the monetary policy stance continues to remain withdrawal of accommodation, which is right in sync with the central bank not being yet comfortable that they have anchored inflation or inflation expectations. So we are still further away from that situation, and therefore RBI also, like Fed, is pushing back market expectations of rate cuts to come around the corner anytime soon, because that is something that can unhinge your expectations and the design of monetary policy going in a certain on a certain path. So RBI will start looking at it maybe in the second half of the fiscal year 25, where in our assessment H2 will be a time, second half will be a time where inflation, as Ajay also said, inflation will start looking more closer aligned to the target of 4%. So our own assessment is 4.8% for the full year. But as we progress, inflation will come closer to aligned to the target of 4%. At that point, we will see perhaps RBI looking at slightly more semi-permanent steps to augment liquidity or to calibrate liquidity. I will not even currently rule out at that part, maybe in Q3, end of Q3 or Q4, a kind of a CRR cut, because CRR cut has not been discussed at all. But that will come only when there is a structure structural deficit in liquidity, which the economy really needs at an effective cost of funding. You know, that economy is suffering because of high interest rates. Growth is, coming down as per whatever the assessments of the Ministry of Finance and RBI in their assessment. So we have to be very careful in segregating the factors that are causing liquidity deficit, whether they are frictional or they look more structural.
So I have the next question, especially for you, Shubhada. A few years back, you wrote an article after the Monetary Policy Committee meeting that you say it best when you say nothing at all. So how many of you have heard this song? Really? Oh my God! We have to update
You say now.
Spotify list with such.
Ronan Keating.
Yes, it's such a beautiful song. Please listen to that song. So coming back to my question, monetary policy communication is a very integral part, right? What you say is also like how you say it was more important, I would say, than what you have to say.
Absolutely.
So since you have been, an economist for so many years or decades, I don't want to make you sound old, but. Yeah. So how do you think this communication has changed from two perspectives? I'm asking. One is definitely from RBI's perspective, how that communication has changed, and also how the market reacts to it. Because I remember a few years back, if there's a 50 basis change, so Economic Times mein that was the only news.
Yeah.
Everyone is like, oh, 50 basis point, oh.
Yes.
But now I think thoda sa what is your opinion?
Yeah.
Have things changed on both ends?
Well, I think communication has become very nuanced in the recent years. I mean, nowhere that they weigh every word of what gets put in the governor's statement to begin with, and then subsequently when you get the detailed monetary policy statement. And I think here, economies or central banks like India's have actually followed the route of what the Fed does. I had been to the Federal Reserve in Washington, D.C., visiting the Federal Reserve Board room and sat on then Alan Greenspan's chair, though I should have sat on some other chair. But so there we were being given a discourse of how the statement of that one page, here we go into reams of pages, but at least now we have curtailed the amount of paper load on monetary policy statement. But earlier there used to be a lot of pages, so it was difficult to get exact message out of it. But Fed actually has an English department which guides the words, how they need to be carefully placed at what point, so that market has no ambiguity interpreting it. And that kind of a nuanced style of communication has, in my opinion, begun to come to RBI in a very quick and more refined manner. As you said, I have a decade so old of experience. I remember the communication used to be a tad confusing in the earlier years. Suddenly RBI would look very concerned about core wholesale price index when WPI was also in the reckoning. In subsequent quarterly statements, RBI would look more concerned about headline CPI. In the subsequent two quarters later, the monetary policy would look at headline WPI. So markets were eternally confused as to what exactly do we need to anchor our expectations of monetary policy path. That has dramatically given way to a significant clarity, less ambiguity, I would say. RBI all central banks like to keep a little bit of element of guessing game to go on. They can't be so transparent, they have to keep a guessing game continue. And if you attend to press conferences, you will see many reporters asking governor as to, can you describe and explain what is withdrawal of accommodation, because none of us exactly have put a finger to the problem of what exactly is meant by withdrawal of accommodation. A simple thing is, as Deputy Governor had put it, that as long as you have, and what Ajay also alluded to was, till you have a deviation between the actual inflation and the target inflation, you cannot expect that RBI is going to hint at cutting of rates. So that being in sync is very, very important. And I think language is as important as the step today, because markets can overread or underread a message. And at the end of the day, markets tend to get disrupted, right, with the wrong signal being received, and therefore mispricing of risks, mispricing of various assets, maybe fixed income or any other. And that, to me, has changed very efficiently for the central bank in India almost since last 6, 7, 8 years, Ajay, I think. Would that be? Yeah.
Thank you. So, when you're talking about withdrawal, yeah. So even I remember even Jayant Verma, who's on the board, was asking, what is this? I used to say either neutral or hawkish or something. Use the normal, natural words, but then we have new vocabulary always propping up. So my next question is to you specifically about the industry. The steel industry is very pro-cyclical, right? So basically you have the most important job, because if you can predict, the wave, so the company can definitely ride it. So I just want to understand, as an economist, there are a lot of macroeconomic indicators which are important, but what are the specific indicators that you focus on, which are different from, let's say, a bank economist, right? Because this is a different industry.
No, I don't think it will be very different. And you said forecasting. I mean, it's important, but you remember what I said, right? I mean, it's that you don't know when Pollard, what mood would Pollard be. That's always a tricky thing for any forecasting, which happens, I think, whether you are in industry or in banking. But in industry, we of course, look at the business cycle, and especially steel, as well as, previously I have looked at some other commodities. So in commodities especially, the global business cycle becomes a lot more important, a lot of commodities actually get priced on global parity, on import parity pricing. And therefore, while, just looking at what's happening in that industry in India is never sufficient. You always have to look at what's happening globally. China has been very important. In many commodities, actually, China is typically half of the world production and consumption. So you will always look at indicators which are world, China, ex-China. And I think I should add something, that nowadays, in recent years, with India's importance growing, at least in incremental sense, a lot of reports have started talking about India and the rest of the world. So, for example, I was looking at the steel numbers, and when we look at the projections, actually, 35-40% of the incremental growth for steel and for some of the raw material consumption is going to be from India. So, in some ways, if we were so used to talking about China and world ex-China, it feels nice if people start talking about world ex-India. So that's happening, and of course, our end use sectors, so how they are performing. So, for instance, it's infrastructure, housing, auto. So those are some of the things, which we have to keep on radar in terms of how they are doing. And then, always, what are the leading indicators? So certain industries, if they turn before us, that serves as a useful guidepost.
Thank you. So my next question is for you, Ajay. Usually when we're talking about economy, finance, we talk about banks and then central banks, because we love them. But there are very important other players also, like insurance company and pension funds, who are operating at a very different horizons. So I remember when many years ago, when I did my MBA, and then we got placed in different companies, and I had friends who got into banks, and when you get your first job, you act like you're the company CEO. So my friend was like, Sakshi, I'm like, अरे बैंक में asset liability mismatch कर रहे हैं, हम लोग कैसे manage कर रहे हैं, क्या बताइए? तो I'm like कि नहीं, ठहरिए, I work in insurance, so my troubles are greater than yours, boss. So you have worked in institutional partnerships at IDFC and Yes Bank. You have dealt with these companies. So just some time ago we were talking about a very low interest rate environment, right? So for them it is difficult, right? Search for yield, because they have really huge horizons, and now suddenly we have high interest rates. So predicting for 1 year, 3 years is difficult. How do you predict for 30 years? So what do you think, because some of these people may end up working in insurance companies or pension funds. So how are things, how difficult or easier things have become for these entities who have longer term liabilities?
It's a very interesting question. Do you want me to limit my answer to insurance or talk in general?
General also, yeah, but insurance I would prefer.
Okay. Well, I think this is definitely far more difficult for insurance than it's for banking. So let me just build a context. In banking, when I used to see the numbers some time ago, that is, a few years ago, the average asset profile of a bank would be 1 to 1.5 years, and the average liability profile of a bank would be 6 months. Now, when we talk about banking, we talk about 10-year loans, 15-year loans, but I'm talking of interest rate adjusted asset profile, which basically means duration adjusted, which basically means that all floating rate loans it could be a 15-year door-to-door maturity loan, but it's going to get interest rate reset after 6 months. So on a weighted average basis, bank balance sheets on the asset sides were largely exposed to 1.5 years of interest rate risk at best, or at worst rather. And liability risk, you will be surprised that all banks, if they actually tenor bucket and interest rate adjust their balance sheets on the liability side, the interest rate risk that they carry on the liabilities is far below 1 year, right? So what happens is that when in a tightening cycle, the liabilities are at a risk of being lost because the repricing will come at a higher and higher and higher price, whereas assets reprice at a slower pace. And therefore, net interest margins end up shrinking through a tightening cycle. In insurance, the challenge is totally different, but here we are talking of 0 to 1.5 years interest rate risk on the ALM desks, on balance sheet management desks of banks. And this risk can be then hedged through interest rate swaps. It can be hedged through some cash transactions that you can do for longer periods of time on the liability side. For instance, I'm sure you know that every bank incentivizes senior citizen deposits by 0.5%. The reason is the senior citizens are very unlikely to prematurely withdraw the deposit and put into a stock market transaction, which I'm sure most of us here in the room would be very keen to do. If we see stock markets go 20% up, then we'll take out our fixed deposits, right? So the prematurity of a FD of a 3 to 5 year tenor coming from a senior citizen is very unlikely to be broken ahead of time. So, there is some level of predictability therefore, and banks incentivize those specific segments to improve their ALM profile. And of course, they have recourse to derivatives transactions where you receive fixed and pay floating to offset the ALM impact coming from shorter tenor of liabilities and longer tenor of assets. But all in 0 to 2 years in general, right? So you're not exposed to 10-year interest rate risk. Those treasuries take to make the extra buck for the bank CEO and the management by trying and trading fixed income in the longer tenors, because the longer the duration, the more the gain for every basis point move. Now let's come to insurance, which is your key question. In insurance, what happens is, I've not run an insurance investment business, but I know that it is a very, very difficult job for two reasons. One, premiums will come over 20, 30 years. Policy persistency is improving in India. I think now most policies are generally persistent if sold through proper bank assurance channels. Persistency is definitely more than 5 years for good bank assurance partners. I can't talk about in general agented business.
50% only. After 5 years, only 50% policies
Only 50%
continue.
after 5 years. So that reduces the investment risk then. But that
you're losing
increases
business,
cost.
but okay.
It increases cost. I understand where you're coming from. But assuming the persistent portfolio, the risk is 20 years of premium payments and managing investment risk of the same. The good news is that in the past there were more fixed assured return plans where the insurance company would give you a 7% or 8% fixed return, but run the risk of earning 5% should rates come down. Now it's all a pass-through, by and large, other than endowment policies where there may be some bonuses that they issue, but those bonuses are on the basis of actually what you earn. And therefore, it's a pass-through. Therefore, I think the solvency risk of insurance companies has definitely been reducing although I'm not an insurance expert, but I think I see that a lot of pass-through is happening, and insurance is really a vehicle to pass through now, right? The second point is that I remember many years ago, I used to be at the forefront of talking to some of the large insurance players like LIC, and I've made tons of presentations personally and my teams to advise them to look at interest rate swaps more actively, which is when you see interest rates go down and you have the next premium coming 6 months later and you don't know anything what you can do to hedge the earnings on that premium, the best is to get into more fixed rate swaps versus pay floating. I'm not sure if insurance companies are following this more aggressively now, but I think those are opportunities that they can use. The last thing is the interest rate volatility is so huge that I remember in one of the organizations from where I moved, my superannuation policy earns 4%. 4%. There's the lowest yielding asset in my balance sheet, right? It earns 4%, and that's taxable 4%, right? Must have been, I don't know which year I moved out and why I moved out that year. If I had known it's going to pay me 4%, I would have probably postponed my exit from the institution. So the risk of being, so these policies are annuity policies, so they'll pay you until you survive 4%, right? So I agree, having seen 4% for life, I agree this is a huge risk. The pass-through element, use of financial derivatives, and lengthening tenors. And the one last thing that I want to mention quickly before handing over the mic is that 10 years ago, if somebody asked me to is there a liquidity for me to invest in a bond of 30 years? There was very little liquidity in 30-year bonds other than government securities. Today, private corporate paper in liquid markets is available to at least 10 years in AAA. Right? So lengthening of tenors has happened. Also products like strips, which is securitized trading of interest rate and principal separately, is also helping insurance companies. I remember we used to do some strip transactions for corporate customers where you do a 20-year issuance and you strip it into 5 years, 5 to 10, 10 to 15, 15 to 20. The up to 5 years will go into mutual funds. The 5 to 10 would go into bank treasuries maybe. The 10 to 20 would go to insurance companies. So there are products available, and I would say that the use of derivatives by insurance in general should go up. It's just the risk aversion, and perhaps they haven't looked at it as a product that can be managed with proper risk management controls. Very often people get scared of the word derivatives the moment you say it.
So you guys are not afraid of derivatives, right? Okay, and that's troublesome 10 years down the line. But today it's okay. And so I started my career with LIC, so thankfully I've always had a long-term perspective of things, because once you work in insurance, you get into that zone. So my next question is to you, Mangesh. You talked about the mic. Yeah. You've talked about globalization, right? So there was a point where it was like international trade and everything. It was everyone's darling, and everyone should do it. But now the reverse trend is happening. India opted out of RCEP for strategic reasons, and the UK FTA has been like going on forever. We have had 14 rounds, if I remember last. So how do you think this trend towards deglobalization is going to impact the steel industry?
So, specifically for steel industry, actually, there were a lot of trade restrictions already, and in fact, those trade restrictions are increasing to some extent, because in Europe, there is one program.
CBAM.
Yeah, the CBAM.
Yes.
So basically what they are trying to do is they are trying to put some tariff restrictions on imports which are carbon heavy, and there are certain sectors, one of them is of course steel. So that's indirectly the trade restrictions are going up for steel specifically. But if I were to look at this question a little bit more generally, in terms of manufacturing, and especially currently, India is definitely following the path of many other countries in terms of pursuing a very active industrial policy. So active industrial policy means basically what? That government will say that we want to encourage certain sectors, discourage certain sectors, and do the necessary steps for that, which could be in terms of tariffs or in terms of incentives. So for example, the production linked incentive schemes that are happening currently. So typically, if you ask any purist, and especially, if I think of the period 10-15 years back, people would have frowned on all kinds of industrial policies. But once, you see the way the world is operating, it's actually being done by many countries, and it's not that, only India is doing it. In fact, many countries pursue these kind of policies. There are a lot of non-tariff barriers, and perhaps it's a game that you have to play. If you want to remain pragmatic, you need to play this game. One argument against that is to link back to the experience of the East Asian economies, the period during which they had a miracle growth based on exports. And there is one theory that let's open up everything, and exports will thrive and it will happen. So I of course have some respect for the theories behind those kind of arguments, but then I would also like to say that look at the time in which those things happened. That was the time when everyone was moving towards free trade, and that was the norm. If today the norms have changed, you can't play by the old playbook. You have to pursue the active industrial policy in some ways.
So geopolitics has had a role to play in last 3 years, mainly because if you look at India or some of the more relevant emerging market economies, you're seeing more of friendshoring, nearshoring. All these terms have come into play mainly because there is a certain sense of comfort with those partner economies to conduct trade. So I think WTO is fast losing its relevance in terms of being friction free, because there's almost a redrawing of global trade map, in my opinion, since the COVID started. And rather, not even since COVID started, since 2018, since US-China trade war started with the tariffs and so on, and China losing the status of MFN and so on with the US, since 2018, you've seen a very dramatic shift in the preferred destinations for many of these emerging economies. And I totally agree that no longer an export-led growth strategy is going to work in today's environment. For sure.
India is one of the biggest litigators at WTO, actually.
Yeah. Yes.
Yeah. So just to continue with you Mangesh, you're talking about the steel industry. It's, I think, 7% of global emissions are responsible for that. So there is a definitely I would say pressure to decarbonize. Now I'm talking from an economist perspective. So this is a very big uncertainty, right? Because these regulations are still evolving. Like today we have CBAM, tomorrow maybe something else tomorrow. Like India also, Ministry of Environment and Forestry might have new regulations. So at one hand you have regulations which are still forming and not like formalized completely, and other end you're not really sure of the speed of let's say JSW, how they can keep pace with these changing regulations. So when you're doing an like modeling or econometric modeling, how do you account for these uncertainties?
So decarbonization journey is actually quite complex. So there are complexities of 2-3 kinds. One is the regulatory aspect. One is it's a trend which is definitely there because of the stakeholder pressure. So in the sense that, say, when you go for borrowing, even your lenders, they would expect you to be sustainable. The society around you would like you to be sustainable. Your government would want you to be sustainable. So there is that stakeholder pressure. Then the regulatory pressure, and third aspect of the complexity is the technology. Because all technologies, there are always in this kind of a journey, there are some technologies which are proven, some technologies that are still on paper and still to be experimented with. And so depending on that, actually the steel industry globally is following different paths. So in a lot of European countries, for example, there is a sharper move, but also helped by the governments. So governments are subsidizing actually steel plants to shut down their old technology, the currently existing technology based plants, and move towards what are called as electric arc furnaces. It also depends on how much scrap availability is there. So scrap availability tends to be better in the European economy. So they are moving there. India will follow a slightly different path. Maybe we'll go from coal to gas first, and then move towards things that are based on completely green, and maybe later on scrap. So it will be a journey, and I think the journey will have to be calibrated based on all of these things. There is also the affordability angle. How much price rise can your customers take? If you decide to go too aggressively on the decarbonization journey, it will have certain economic costs associated with that. So it's a complex thing based on that. So if you ask us, I mean the industry. So JSW has recently announced that we would be a net zero by 2050. So that's a target we have announced. A lot of other steel companies have announced their targets. So it's a journey, and I think the path is clear, but the actual evolution will depend on all of these things. Maybe 5 years down the line there will be some development in the technology that I don't know of today. It will be there. It will become, or maybe something that's on paper today will become affordable and commercially viable at that point in time. So the exact pathway will be somewhat, evolutionary and not completely known with certainty today. But I think the goals are clear based on all these things that are happening, the pressure from the stakeholders as well as from the regulators.
So to continue in this vein, we all have good hearts. We want to be good to the climate, but financing is a concern, right? Climate financing. So just to take India's example, we had $1 billion bonds, right? Last year we issued, I think, 2 or 3 bonds we issued, and even 3, yeah, and even Exim Bank had a $1 billion sustainability bond. Overall, $23 billion bonds were issued, out of which 84% were actually private players, and the rest was government. So what do you think are the challenges going forward? Can India actually be able to raise the funds that it requires to make, pursue this greening path?
So you want to take that? I mean, my perception, on this is that there is a large need for India's green transition, across sectors, and it's beyond, the current, at least the currently visible supply that we have here, and there needs to, at a global level, there needs to happen a transfer of resources from the Western world, who were historical polluters, to the world which is now developing, and therefore our energy intensity and emissions intensity is increasing. So there needs to have, funds transfer needs to happen, and globally the platforms are struggling with finding the ways of increasing that transfer. So some beginnings have been made, but I think developing countries say very correctly that it's meager in comparison to the needs that are there, requirements. At the same time, I'm hopeful that this flow will improve, and there are, as a private industry, if we want to tap some funds actually for green transition projects, we can identify projects. Then I understand that there are avenues available. So it's not completely shut out also. So from a country point of view, I think a lot more transfer needs to happen, a lot more availability of funds needs to develop and evolve over time. But I think we are moving towards that.
Institutions should do that, right? Multilateral.
Yeah.
So IFC recently financed, I think Aditya Birla only. I was very surprised by that transaction actually. So Aditya Birla was, they acquired a company, but then they told IFC that because it was a textile company and a lot of women are working, so it is for gender equality, and that is how they pitched to IFC. So I think that is also a technique that you have to learn, because these multilateral organizations have different objectives, and so you have to say that you also have similar objectives, I think.
Yeah, I think they need the I think they need the documentation and the ability to monitor. So when you say that the funds are going to be used for a particular purpose, so say let's say a green transition, then you should be able to demonstrate that it's that it is actually used for that, and there should be systems developed for monitoring that. So I think the critical part for companies is to develop those systems. And then you convince the lenders that we have the systems to ensure the monitoring of it.
My couple of comments here. One is that ESG is a great theme, and the world is moving towards ESG very clearly. Now the question simply is that there are more funds to deploy to ESG compliant sectors than there is the entitlement from the corporate side to borrow those funds. At this moment of time, the apple cart is tilted in favor of investors versus borrowers. And that specifically applies to countries like emerging markets and India, even though it aspires to be a DM soon, but is still an EM, right? So if we are EM, we still do not qualify because a lot of businesses have not necessarily fully revamped their production processes and manufacturing plants to be ESG compliant. So that's one point. The second point is that corporates are realizing that if they don't speak this language, they have zero chance of raising long-term sort of debt and equity. Increasingly, ESG funds, in fact, I would even go to the extent of saying increasingly foreign institutional fund flow in India will become more and more ESG aligned. You don't have to be an ESG fund to be able to fund a project in India which is ESG compliant. Any capital that comes from outside the country increasingly will get more inclined to invest in a company if that company is ESG compliant. There is a market common talk that they do not like tobacco business, so you will not see a lot of FII holding in ITC, for instance, or VST Industries, or whatever, Godrej Philippe, or the manufacturers of tobacco and cigarettes. Likewise, casinos, likewise, a few other businesses. Now, those were relatively more prohibited businesses in the past, but increasingly this capital will come into companies. FPI holding will start looking at how much carbonization you are doing in the market or how much pollution you're doing. The third point is the ESG, S and G are very amorphous to me. I mean, they are ambiguous terms. S standing for social and G standing for governance. Now, the fact is governance is pretty much a prerequisite for any company. For any listed, unlisted company, you're in the business, you need to be well governed. So I'm not sure what G in ESG really stands for and how do you distinguish unless you are just simply saying well-governed businesses versus poorly governed business. But I would say that the regulator wants every business to be well-governed and therefore it's the minimum criteria, and G therefore is very ambiguous to me. S is being misused very often. A lot of S is about, am I doing good for the community? Some of it is obviously very legitimate, but some of it is being misused. So to a large extent, some of the greenwashing that is happening is in the world of S, significantly in the world of S, and some partly in the world of E as well, where people from rating agencies, particularly in the West, come down, see your plant and suddenly give it a tick in the box on the E. So I think this is a start. I think ESG is, from an issuer side, is not necessarily a fully compliant process at this moment of time. It's more ticking the box from the issuer side. The investors are under pressure to having raised money from LPs. Their GPs fees doesn't start unless the funds are deployed. So there's pressure from the investment side. The issuers aren't ready. So somewhere they're coming together in the middle of the road and shaking hands. This will get refined and far more characterized by more the right issuers over a period of time. That's my view.
Also, I think the trade barriers are getting created by, say, EU, the CBAM is basically that, and India is up in arms in negotiating with EU because that's why they want to put barriers to imports which are not clean. Clean industrial production. So I think these kind of hurdles will enforce an ecosystem where everyone willy-nilly will have to, eventually go there. But how soon and how quickly? It's not just the issue of finance. It's just the whole, I would say, a simple testimony of that is right from COP26 onwards when everyone set targets. There has been, of course, COVID struck, and then every economy was struggling to dilute their own commitments towards what they had done in COP26. So I think it is an eventuality. How long it will take to transition is anybody's guess.
One more quick point to make, and this is for everyone in the room. If there is a green deposit from State Bank of India at 6%, and there is a normal deposit at 7%, which one will you take? Yeah, you'll take 7, right? right?
You are the good guys, you should not
How many
forget.
people will take 6? Raise your hands. Right, so this is what the sensitivity to ESG, climate risks has to be actually born in the minds of each of us.
Yes.
Are we willing to do something for the planet? We're going to say, no, somebody else will do it. Let me make my 7% and get out.
Yeah.
Anyway, 1 साल की FD है. क्यों इसमें क्या दिमाग लगाने का? How many of us, while booking airline tickets, will actually pay an extra $20 or $30 for reducing carbon emission by the airline? So it's not about businesses. It's about each one of us, because ultimately businesses sell to us. So how much are we committed to climate control, and how much are we committed to ESG? Or is it just an esoteric concept for panel discussions? That's the reality of it. How much do we feel about the climate and what we're going to leave behind for our kids and grandkids?
Yeah.
And until we start changing our behavior, businesses will remain fairly commercial minded, I would say.
Recently, there was a survey in the Economist. So if you see EU, many people are very like green-minded, and they were. But now, when they have to like change those heating pumps, and it's costly, now their minds are changing. They're like, no, no.
Commerce and finance takes root.
Yeah.
And everyone is now more preoccupied with their own growth rates, and these transitions will, they're bound to have certain giving up the near-term growth gains for a longer-term benefit for everyone.
Last one is the world is deglobalizing.
Yes,
How do you expect individuals to start thinking global when businesses and governments are?
are not exactly.
Yes. So one point, you talked about credit rating, and so recently, Chief Economic Advisor, Anant Nageswaran, he published essays re-examining narratives, and one of the contentious, if I may use the word, was the essay that the credit rating for India has been a little depressed, even though if we see the history, we have never defaulted compared to, let's say, quite a few Latin American countries. We have never defaulted, and last few years, if we see the trajectory, we have reached number 5 globally. So definitely our credit ratings should reflect that. So when you're doing credit rating, I mean, you have worked there. So, but more for the audience, when you're doing credit rating, there are 2 criteria, right? One is the quantitative side where you're seeing, and then there are where I think India does well. We have been doing quite well for 20 years. The other is the I would say subjective criteria, where we have World Bank indicators, right? Political accountability, corruption, freedom of speech, and all those things. And the essay contends that this is where India's rank is reduced, and that is why the overall ranking is reduced. And the problem is not just for the government, because that raises our cost of funding, but even for companies, you cannot have a credit rating higher than your country. So ultimately, both suffer, and there's quite a huge loss. If we have a better credit rating, then we will be able to do many things, including climate finance. So what do you think? How can this conversation happen where we can, discuss or sit down with the global rating agencies and see how this problem can be resolved?
Yeah, so this is I was hoping that this doesn't come my way.
Okay, maybe you should have told me when we were having coffee.
No, I'm just kidding. The ratings is a very different business, right? I mean, some of you might join CRISIL or ICRA or CARE. I don't know where some of you would be headed. But the problem is that sovereign ratings obviously will not come from within the sovereign. They have to come from outside. So here you depend on S&P, you depend on Moody's, and you depend on Fitch. These are the 3 big ones, and then there are a couple of others like DBRS and all that. The simple point is that I truly believe that India deserves a better rating than BBB- today. I truly believe that.
Yeah.
And why I believe that is because if you said it 20 years ago, I would say very volatile sort of short-term, medium-term interest rate structures, very volatile sort of fiscal discipline, very volatile GDP growth, and so on and so forth. But now a lot of it has changed, and I think we are a fairly stable sort of country, I would think. Our currency has depreciated at something like 2.5% per annum over a long period of time. Our interest rate structure is pretty firm now. I think the short-term interest rate volatility, like I've seen in mid-90s call rates of 120%. We don't think of that anymore, right? We don't think of short-term rates being 20%. I borrowed corporate money at 20% in 1993-94 in a bank. Right? So those things don't happen anymore. We don't think of 20%, 40%, 50% interest rates as perhaps Venezuela, Brazil, Argentina, and some of the other countries do. So we are a fairly stable country, and we have a strong track record of stable interest rates, stable currency, and stable inflation. And a fairly moderate sort of fiscal deficit. Of course, that needs to come down. The FRBM Act, originally proposed by the Congress government, UPA, was that by 2009 would be zero fiscal deficit. That's got now pushed to 4.5% by 2000.
2.5%.
2.5 was it, or zero?
Oh, revenue deficit.
Revenue deficit. Okay. Okay. So 2.5%. Where are we now? We're talking of 4.5% by 2026.
Yeah, we are talking of 4.5.
4.5% by 2026. So I think if we get to 4% of fiscal deficit when US alone is at 6 today, and US has lost its rating, by the way, so it's no longer a AAA. So I think the world is moving the other way. Maybe they'll all come to match BBB minus. I'm just kidding. Yeah. So the point is, I think India deserves better. Definitely deserves better. The macroeconomic stability, the corporate sector, the fact that corporate sector is now significantly deleveraged. Top 500 listed companies in the country are operating at a debt equity of 0.6. Right? They have huge potential to leverage their balance sheets and make investments into plant machinery and new projects. So 0.6 debt equity is fantastic, for 0.5 actually, FY25 expectation. That shows that the corporate balance sheets are deleveraged significantly. And bank balance sheets, NPAs have dropped from 8%, 9% 5 years ago to 2%.
I remember
14%.
NPAs.
Yeah, 14% at one point, but let's say 5 years ago, GNPAs were more like 9 to 10%. They're now at 2%. Net NPAs for the entire industry, banking industry, is now at below 1%. So we are absolutely strong at this moment in time. IBC has helped. Insolvency Bankruptcy Code has helped. More than 10 lakh crores of assets have got sorted out there. So I think overall India deserves a better rating. I'll leave it at that. Now the point is whether S&P and Moody's look at us in the same way as we look at ourselves. Very often perception is higher than others perceiving, right? Because in corporate India, if you go and say to anybody that you're not a 5 on 5 in performance, they say, come on, I did the best, and this is a fantastic contribution I made. So self-perception usually is higher, but I truly believe that with industry, manufacturing coming of age now, 10% growth for the first time in many years, almost 10% growth in manufacturing. Services, in fact, softening a bit now to 8%. Agriculture is the only area which at this moment in time looks weak, and rural reforms and more rural focus is required by the government. But I think in general, the next 5 years, 10 years look really good for India on a comparative scale as well, and also on a individualistic absolute plane. So I think India deserves a better rating for sure.
Okay. So, okay, you want to add?
Ditto.
Okay. Okay, I thought you wanted to add something.
No, I just want to add one anecdote. I mean, I completely agree with what he said. In terms of this disparity between, if you look at the quantitative approach, then India's rating should have been raised many years back.
Yes,
I
the qualitative is
I remember
the
when I
issue.
was in Economic Times, which was maybe more than 20 years back. I mean, I had done a story that time about how India's peer raters, compared to that, how India's macroeconomic fundamentals are much better. So this is not just true of today. I mean, it was true 20 years ago. But it's basically the qualitative factors on which these rating agencies are taking a view. Maybe it will over time, if the rating agencies don't move. The markets are already moving in some ways. I mean, they are already giving us better rates than what our credit rating would strictly result into. So maybe markets will move there if the rating agencies don't move.
I think the markets will try to determine that.
I would say the markets already price India at A minus or so. Just look at the way flows are headed to India.
Exactly.
Equity flows are huge. JP Morgan bond index and other global indices are going to include us. We'll
In
have
June.
billions of dollars of flows in the next few years. Rupee is likely to strengthen to 80. That's what my view is. Interest rates are stable. Indian corporates get priced actually at A minus or A in the global markets.
Let's even look at the 1 decade, and you are from fragile 5, you're in the top 5, top 3. I mean, it is backed by structural transformation.
Absolutely.
So it's not just a kind of fluke, kind of an achievement. It has been by design, and I think that has helped a long way to get that stability.
So I would like to change the track a bit. How much time we have?
I think
It's over. Okay, then fine. Then I'll just ask my last question and open for Q&A. My last question is more for the students. Is that it's a difficult job market right now, and so what do you think? Because you've been in the industry for so long, what do you think are the skills that these people should develop during their 2 years in MBA, so to be job ready? What are the skills that are now needed? Because the banking industry, the BFSI sector, or the economics profession has changed a lot over last 20 years. So what are the technical and skills otherwise which are required?
Let me attempt. I think once you have the MBA degree, technical skills, beyond a point, obviously when you join an industry, you will look at what specific skills you require. But I find, from my perspective, when I go to some institutes, maybe I'm just going to those institutes where technology is not playing still a big role, I feel that all of us have now almost a necessity to be very tech oriented in the way we think. Some of the people I worked with in the last, even my last assignment and a few others before that, used to think technology is a supporting function. It's not a supporting function at all. It defines a business today and it causes disruption in the market in any form. So if some of you are less tech oriented, I would urge you to be more and more tech oriented in your thinking. If you are, and not everybody can become a programmer. And by the way, the big man, what's his name, Jensen, of the owner of NVIDIA, was recently in the press saying you don't need to be a coder, but you need to know how to use these tools for your benefit. And I haven't worked on AI yet, but some of you should really spend a lot of time in understanding how to harness the power of technology. It's not about learning to program, and it's not about learning NLP or learning any other language. It's really about understanding how tech can help you. Because willy-nilly, a lot of you will go to services sector, and it's important therefore to understand how to use technology. The more important point I would say is that we have all seen these cycles. Currently job market, some institutes will not get full 100% placement or not the placement of your desire. Don't let this rattle you at all. And this is not I'm not just randomly giving you a speech here. Don't let this rattle you. Life is a long 30-40 years of work. Don't let the incipient 1 year, second year pressurize you too much into making hasty decisions. Definitely look for your inner voice and what you want to really do. Don't go by pay packets, please. For heaven's sake, the youngsters today are in a hurry, and my little advice to you would be pay packets, are not as important as you start as what you really want to feel passionately about. So if you feel passionately about a particular area and that pays you 1/10 or 1/5 of what a large paying job will do, take it, because maybe in that area you will do 100x, whereas the 10x that you do today will grow at 10% per annum. Who knows? So, life is not about projecting 40 years. Life is about doing work that aligns to your passion.
Absolutely. He's spoken for us.
So we'll open for Q&A if you have any
On a lighter note, long ago in Economist, it was a forecast made, prognosis that once AI/ML gets mainstreamed, the professions that will lose relevance first, economists.
So please raise your hands if you have questions, and then we can pass the mic to them. And please also share your name.
Good afternoon to the panel. Thank you very much for the session. Myself, Yash Kondkar, and we were discussing related to climate change alongside the trade that's going on. And considering the overall climate change scenario that comes up, that whatever we are trying, maybe that globally economies are trying to be self-dependent rather than global dependency. I had just one thought, overall thought, and I wanted to check with you that I had heard that material footprint considerations of India are 4 times that of the globe. So the rate at which we are extracting our resources, material resources from India, natural resources, are 4 times as at the rate at other countries. So when we think about the long term for any manufacturing sector or any other sector wherein we are trying to increase the industrial production or otherwise, so at that point, maybe India may run out of resources much before other countries in this sort of scenario. So at the macroeconomic level, what sort of strategies can India or countries similar to this think about? And there was another thing that I just wanted to understand, that basically suppose other economies in the globe, maybe they are not coming to the forefront in terms of economics wherein they can use their resources for the globe by exporting. For example, there is Africa, etc. countries wherein there is drought, or maybe they have a lot of natural resources but they cannot actually produce and supply to the globe. And due to that, some major economies are using their resources at a much higher rate, and maybe they will get extinguished at a rate, and after that they may be in a very difficult spot. So what sort of things are we thinking about in that direction?
Yeah. So, in terms of materials, so this statistic that you mentioned about, I don't know about that. Yeah? So first let me clarify that 4x, but I get the sentiment of your question, that it's basically, are we going to run out of the materials because we are growing at a fast pace and that will require resources? I think that's the question, right? So in most of the resources, the running out, I mean, those kind of scenarios are actually some time away, and they are not in the imminent future, and definitely not inevitable also. So what happens typically is, the answer for this is little mixed. There are always factors which are raising the concerns around resource security, because for a lot of materials the grades are coming down. Also, some of the materials are in geographies which are geopolitically in difficult regions. You didn't name China, but basically, yeah, China has been investing in Africa and trying to get resources from there. So countries are doing that. Countries are doing in their self-interest those kind of things. Also, the response to that is what? Is basically to increase the exploration efforts, put more budgets into exploration. So exploration is always an activity which is very, it's subject to uncertainties and very capital intensive. So requires a lot of capital. So how do we get more and more investments into that? So that should be the thinking of the governments, and which is what is happening in some cases. India has been trying to, recently you would have read about critical minerals policy. So we are trying to increase our resources in those areas. So every country will have to increase the resources. Also remember that for a lot of resources, subsequently your requirement can come down because of recycling. So the effort should also be pushed in that direction. And then, who knows, 10 years down the line, technologies will open new chapters. There will be undersea resources which, will become commercially viable to be secured. So while on one hand we have to be mindful of the resources, not waste resources or look at recycling wherever possible, I think we should not also go to the other extreme of saying we don't want growth because, we will run out of the materials. I think so, avoid both the extremes in the thought process is what my suggestion would be. Look at it more pragmatically. In future I'm sure that, some things will, possibilities will open up, and will not have those kind of, doomsday scenarios where we actually run out of certain resources. So let's not go to that extreme. At the same time, be conscious, use resources efficiently, don't splurge. So we have to have a balance, I think, in looking at resources.
And who knows the pace at which R&D happens.
Yeah.
You get a big bang for the buck.
Yeah.
So
Just one point to add.
Yeah.
Mining is one of the sectors in India that a lot of people, we don't know much, but it's been very heavily abused in the past. And there is a lot of illegality. I can't tell you more here, but lots of groups, local businessmen in a lot of these mineral-rich states, without naming them, who have done 10x, 20x in a single year, right? and taken, and this was all things of the past in my view. I have not been in touch with those businesses over the last few years to see whether they are still thriving by illegally mining and exporting and all of that. But I think this is a sector, because it's natural resources, it's a sector where the government needs to perhaps put more attention, not just the center but states as well. And at least the illegal mining and illegal profiteering from natural resources can be curtailed. And this is one sector where perhaps public sector can dominate because of their natural affiliation to their larger shareholder, that would be the government. They could retain these resources for longer. That's what I really think. See the abuse of the coal auctioning system of the 90s. And there were power plants that were making more out of coal trading than they made ever through power generation. There is a massive abuse in this country on minerals in the past. I don't know about the current status. I'm not qualified to answer. But I think this is one sector where government should not leave control.
Good afternoon. I'm Ram. So, as we talked about the climate finance strategy, like then again taxation for the sustainability. So, my question is that, like in the countries like developing us, is it possible that carbon pricing will be there in the near future, or is it possible that carbon border tax will be implemented in the near future, as you are stalwart in there?
Well, I think it's happening. I mean, what EU has initiated in the dialogue is the CPM.
Yeah, correct.
I mean, that is just the initial example of how. No, I think my voice is loud.
I think that's just the beginning of it. And then, to ensure and inculcate more disciplined kind of ecosystem across the globe, I think these kind of barriers will continue to get erected. I mean, that is a different story, that they were historical polluters and now they are imposing it on us. And a classic example is how US shifted all of its manufacturing to China and blamed China for pollution. I mean, that's where the double standards have erupted and have got discussed and debated between the developed economies and the growing or emerging economies. So a lot of awareness has come through in it, and if you follow all the discussions and debates of various top committees, this is exactly the point that has been made, that at what more acceptable kind of barriers that need to get created between the two, because those have grown, they have developed, but what about the aspirations of the emerging economies?
My next question is that only, like, it is like possible for the developed world in the Western countries, for the South, what we are today. So is it not possible for us to like compete with them, like in terms of the carbon pricing? Yeah.
So see, I completely agree with with this kind of sentiment that there is some injustice happening with us when we are growing, and these costs are coming to us. And I agree, with that sentiment. But at the same time, I'll tell you one other side of it also. A lot of these carbon decarbonization initiatives, they are about energy efficiency. I mean, you get your energy use if it comes down, the energy intensity of your production comes down. So you will be surprised, a lot of decarbonization initiatives actually add to the profits of companies. Because they bring down the cost of production also. So you can look at it at one level as, let's say, decarbonization, but on other level you can also see it like conventional cost reduction initiative. So that is also happening. So I think our approach should be not to say that we won't do it. I think the approach has to be that we are willing to do it, but we are at a development stage where we'll need time and certain adjustment factors, and we should keep getting into a dialogue about that, about reducing the pace of it. But we should not actually try to resist the direction in which things are moving.
It's an inevitability. You can't get away from it, but how best you balance your near-term aspirations with long-term sustainable goals.
That's the key.
Thank you.
Hello, good afternoon. My name is Bhavish. So, as ma'am said that when US sneezes, the world gets sick, and the dollar is a very big part of the economy. And now we were trying to change the currency of the oil trade in the BRICS summit. So, and as said that our story of growth is mostly local and not very global. So, how will that support this cause? And is it possible to get out of the shadow of the dollar?
It's a good question, but I don't think there is an easy answer. The story of the petrodollar is still firmly in, despite the fact that a lot of pundits have been talking about the demise of the dollar and pricing the oil trade in euros or in some other currencies. To my mind, the force of the US is still strong. Its market cap is $51 trillion. Its GDP is $32 trillion. The closest second is China at 17 or 20 or 18, whatever number. And then the third largest would be in the region of 4, 5, and then India 3.7. So the $32 trillion market will continue to dominate, whether we like it or we don't like it. The elephant in the room is the US and will remain so for a while. Having said this, the fact is that Japan is the only country that I am aware of that actually achieved pricing their product in Japanese yen in the global markets. And as a result of that, 750 yen to the dollar went all the way to 75 yen to the dollar, right? Because everyone wanted their products and yen kept appreciating big time. India is not at that stage. India is a domestic market. India depends on foreign supply of capital. Its local banks can give you capital for working capital and for some projects. But local banks in India can't give capital for both equity and debt for the long-term trillions of dollars that India needs. So for rupee to become a Japanese yen looks unlikely to me. Having said this, rupee will likely remain fairly strong and stable, is where I will just close my comment.
I think also any economy needs to have a meaningful share in world trade to be able to make inroads into a currency that can dominate. Incrementally, what US did to Russia in isolating, that sort of, let the pigeon, in, because isolation means, in fact, the whole thing of the SWIFT being explored as alternate. India is looking at INR settlements. So incrementally you will see, but I mean, it's a dollarized economy, global economy. It's just going to be a wishful thinking that we can wish away dollars, but it's not going to happen. Look at what aspiration Euro had when it was launched, and see where it has landed itself. So incrementally, if I look at it, stock, definitely dollar. But if you look at flow, since the time these disruptions have begun, more and more economies are exploring. They're not there yet, but they're exploring how to build their trades in their own currencies and so on. But it's a decadal effort that will need some kind of even a few percentage point change.
Any last question? One last question and then we'll wrap up.
Good afternoon, everyone. My name is Sayukta. So we all know that India boasts the largest population among all nations. So my question is, what are the challenges India can address for the unemployment generations, and what all job opportunities can be created more?
This means a big answer.
This is the toughest question ever.
For this long scoped answer, I can just give two-word answer that demographic dividend to remain a dividend and not become a disaster. Our policy making has to unequivocally focus on skilling and reskilling. and making the population employable and remove this whole new occupation of being an influencer in the world. It's the most unproductive activity in the world. Does not create any productive assets. I'm not,
social media.
yeah, I'm not joking. I mean, I draw a lot of lessons from anecdotes. And when my support staff at home is spending a lot of time on trying to be an influencer on social media, it makes me shudder. You know, that this is where the productive time goes and gets frittered away. But coming back to the mainstream argument, I think India needs to focus on skilling and reskilling. And that is not just the responsibility of the government. I think the heavy lifting ought to be done by the private sector because they know the skill gaps, they know the gaps in terms of, the classic dilemma since COVID times is we are really running short of labor. And here you have a problem of huge unemployment. So how can the two rest together? It's basically you need to impart right skill sets to the vocational training or whatever.
So less social media and more panel discussions. Okay.